So there's a massive opportunity in the world right now with, I think it's 23% of businesses in the Western world are owned by the baby boomer generation. What's that mean to us in terms of, if you want to go out and buy businesses, how does that relate?
So I think if you look at the USA market, you look at the Australian market, you look at the UK market, there's obviously post-war there was a lot of kids that were born, which is part of the baby boomer generation. These guys were born in an era where building a business was part of what you would do normally at that point, and they've built millions and millions of businesses that do plumbing, that do electricity, that do engineering, manufacturing, all kinds of traditional businesses, right? And these people that have built the business up are now becoming 60 years old, 70 years old, 80 years old. They don't really have a succession plan right now. And to be honest, there's not that many buyers running around. And there's millions and millions of baby boomers that are retiring. So what does that mean for us? That means that it's a buyer's market. There's a lot of people that have no succession, that want to sell the business, but there's no real professional buyers out there. And that's where we come in. And, it's an industry that you can partly join into, you can, capitalize on. And obviously, over the next 10 years, there's a massive, massive opportunity that's coming around. So, if you look at the numbers, there's about, I think, 10,000 or 12,000 baby boomers retiring in the USA alone every single day, which means that there's tens of thousands of new businesses that are coming out into the market. I would say, based on the numbers that I've seen online, don't take my word for it, but 1 out of 5 businesses tend to sell. So there's 4 out of 5 that you could potentially buy into. And these are well-established businesses that have had a 10-year plus track record of trading well. They're probably making in between 5 to half a million EBITDA on a yearly basis. There's no buyers, so it's kind of like all the variables, as we mentioned on one of the podcasts that we've done, are aligning themselves so that you can capitalize on the opportunity. So there's a massive, massive opportunity going on right now where you can buy.
And I think that, in short, you've got these baby boomers that have owned their business for many, many years, built it up, very successful. Their kids probably don't want to buy it because they're more interested in probably making money on Instagram or YouTube.
Yep.
And they see how hard their mum and dad probably work at the business.
Yep.
So it's not for them. The business, if it's sort of between 1 million and 50 million revenue, isn't really big enough for private equity. Private equity generally tend to only get out of bed for more than 100 million.
Yep.
So it's then, what do we do?
Yep.
So that creates opportunities for people like me and you to buy those sorts of businesses and build them and scale them and build larger groups. It gives opportunities to other people that want to get into M&A. It gives opportunities for other small and medium-sized business owners that want to grow and expand their business because they could go and buy up these baby boomer businesses and bolt them into whatever sector it is that they're in to make their own businesses bigger and better. So it's a huge, huge opportunity. But would you agree that you make money when you own a business, or do you think you make money when you create those capital events?
I think obviously if you own a business and it's a good business and it's making good profits, you can pay out yourself a dividend year end and you're going to make good money out of it. However, if you look at the newspapers, the typical events that tend to be celebrated online are the exits, right? And it's on the exits when, and I've seen this online and I've seen this on myself, is really when you save up money is when there's a large chunk of money coming in into your bank account and you don't really know what to do with it. If you're receiving like a monthly paycheck, it's kind of like your lifestyle tends to go up and it meets that new revenue that you generate on a monthly basis. So I think you make the proper money when you sell, but obviously if you've got a good business, you can take out some good dividends out of it. I think your experience has been even more aggressive, right, on the selling and on the buying and selling and improving these businesses, and then looking at when do you actually generate the money. What's been your experience, Paul, on buying and then selling these businesses that you've bought over the last 10 years? When have your real, I guess, wealth pattern changed?
So look, I think income is just what you spend. The more you earn, the more you spend. Yeah, most people live to their means. If anything, probably people spend more than they actually earn. So I think if you can create those capital events, so when you sell a business, the sorts of money that can be generated off the back of that can be much more significant than whatever the dividends or the monthly paycheck from those businesses were. So for us, it's all about creating capital events. Buy a business, build it, sell it, move on to the next one.
Yep.
And that's really, creating those capital events. You can then reinvest that capital into income producing assets, whether it be real estate, whether it be stock, shares, bonds, whatever. You can create that sort of passive income. So almost like, while you sleep, you still make money.
Yep.
But I guess most business owners typically will, buy a business, or start one and grow it over a long period of time, and then they'll look to exit. Our model is slightly different in that we want to create many of those sort of capital events, and they can be quite life changing. I mean, I love business programs, and one of the programs I watch quite regularly is the Dragon's Den at Shark Tank in the US. If you look at all of the dragons, the people that are investing, they didn't make money from starting a business or owning one. They made money when they sold one. So Deborah Meaden sold a leisure business for an 8-figure sum.
Yep.
Stephen Bartlett, he's a 28-year-old entrepreneur, started Social Chain and sold for many millions. It's about creating those capital events for me that I think can be quite life changing.
Yeah, 100%. I think that's when you've also got time. And when you've got capital and you've got time, you can either get really bored or you can do some really amazing things, and that's when the real game changer comes in. I think okay, let's say that you want to sell a business because that's when you make money, right? What needs to happen before that? Obviously, you need to buy one. How would you go on about buying your first business right now, Paul? If you were to say, we'll leave you in the middle of London. No money, no capital, nothing. You don't know anyone. How would you go on about buying your first business? Let's say you start with 10K, 10 grand, okay? And you want to, by the end of the year, have like a 10 million turnover business. How would you go on about doing that?
So I think as we spoke about in the first episode of our podcast, it's, if you've got no experience whatsoever in mergers and acquisitions, well, go and partner with somebody that has. Go and find a mentor or a coach or learn about it, and then learn from them, do a few deals, and then if you want to go off and do it on your own, it's much better to do it with that experience. We've got experience of doing almost 100 deals, and not every single one of those deals has gone perfectly. And even now when we do a deal, we will always learn something and think, next time I'm probably going to change that process a little bit because of that issue or challenge that we had. So I think find a mentor, find a coach, understand how it all works, piggyback off them in terms of their credibility and experience. We do no money down deals. It's a myth that you need to have lots and lots of money to buy businesses. The vast majority of businesses we buy are not with our own money. We borrow the money to do the deals, and that's, people might think, well, that's not possible, or I've got a dodgy credit score and that's going to prevent me. We adopt a model called a leverage buyout, where we leverage the assets of the business. So the money is raised in the company that we want to buy, that generates a down payment, and then the balance is usually payable over a period of time, or there's some sort of earn-out structure. Once we own the business, it's then about looking at how can we improve it. So what you tend to find is when it's been in the same family, for example, for many years, there could be some processes that could be improved. Maybe the website could be overhauled. Maybe we could make it more engaging. Maybe we could improve the marketing. Maybe we could spend more on social media advertising. Maybe we can adjust or improve some of the sales processes. All of these sort of subtle changes can sometimes have massive impacts to the business. So it's all about buy the business, make it better, sell it, and that could be just on a one-time basis, or it could be on a multiple. So you could buy 10 businesses. We're involved in the caravan and motorhome sector, aren't we? And we've bought, I think it's 6 businesses so far. And we go into each one, we look at where can we improve the marketing, where can we improve the sales, how do we make it more profitable? And most businesses typically sell for a multiple of profit. So if you buy for a multiple of the profit and you can make that profit more and sell for even the same multiple, the idea is to try and sell for a higher multiple, but even selling at the same multiple of a higher profit means that you're creating that capital event that then becomes quite lucrative, and then you can plough that money back into either income producing assets, or you can invest that into future deals.
Yeah, I think that, none of the big boys use their own money in order to buy a business. Like, if you're clever enough, you utilize other people's money to buy a business because that's how deals at the professional level tend to happen.
Look at the biggest deal in the UK in 2021. Walmart, big massive US supermarket, sold its stake in Asda, the UK supermarket, very big supermarket chain here in the UK.
Yep.
And it was a £6.8 billion deal, so almost $10 billion, and the vast majority of that money was from the banks.
Yep, and
That's how it works.
Apple has bought I don't even know how many businesses last year, and they didn't utilize. Well, not the CFO here, but I know they utilized the debt that they could raise from banks. That banks want to lend you money, like they want to give you money because that's how they make money, right? It's if they've got the cash sitting in their balance sheet, it's a passive. It's like a liability for them because they're not generating income out of it. So you need to work with what the banks want, what the seller wants, create a deal that meets their expectations, meets their requirements as a seller, and take the business from there. That's how we tend to do it.
So we're let's say we're starting out, we're buying a business. What's the sort of typical process that people go through from sourcing that deal right the way through to actually getting it over the line? What's the sort of if you were going to summarise the process?
There's 5 to 7 steps that tend to go into it. First, you need to find the deal. You can do that through brokers. My advice would be try and skip the brokers because they tend to be more of a stoppage rather than of help. But it could be a good first step. You start talking to more sellers. That way you've got all the information already created. So it's kind of like an exercise that you can go through. But I would say focus on traditional marketing campaigns such as email, letters, LinkedIn in order to access the sellers and the business owners. Then from there have the first conversation. You get the NDA, so the non-disclosure agreement. You receive the financials. At that point you need to have the skill set of understanding what a balance sheet is, what items are on the balance sheet, understand the P&L, how you can get to the EBITDA or EBIT or net profit level. Once you've got those two variables, you need to come up with a deal structure, which is another skill set all by itself. And at that point, you need to know how to sell. So you need to be able to present a well-structured offer to the seller. Once that gets accepted, you need to understand the legal frameworks of what an LOI, or so like a letter of intent or heads of terms, term sheet is. So that's another skill set you need to have. You need to know how to present that well. You need to understand how to meet expectations around timelines, around timing, around what the next steps will look like. You need to then go, if that gets signed, move on to the due diligence stage. At that point, you need to understand what key framework, like what key aspects of the business you need to analyze. So like the financial aspect of it, the operational aspect of it, the legal side of it. And once you've got that covered and you're okay with those aspects, and I think that's when having started a business, understanding what the key insights or what the key variables that go into business comes in, because if you don't know that there's a legal aspect to it, there's an operational aspect to it, there's a financial aspect of it, you don't really know what to analyze inside the due diligence stage. You can always hire third parties, but it's going to cost you more money. And then at that point, you need to have the legal framework on the share and purchase agreement, board minutes, the different people that are going to go into the legal arrangement, and then you need to understand the financing aspect of it. So you need to understand how banks work, how the projections need to align with what the bank's expectations are, plus what the business will actually do. And there's a lot of variables that go into buying a business, but if you've got those 3, 4, 5 different steps more or less sorted and you've got expertise on those, then you get your first deal done. That's
yeah. I mean that sounds like really complicated stuff. You need to be a lawyer, you need to be an accountant, you need to be a financial analysis, you need to be a bank. We're not any of those things, and we hire experts to help us with all of those things and understand and navigate through that. But it ultimately is just a process. Find the deal, put it through a process to see if we can tie something up, do the due diligence to make sure we're buying a pretty decent business and we understand what the risks are, get the funding to make the deal work, get the legals done and get the deal done. It is just a process. There's a lot of work and effort that goes into it, but it's a fairly straightforward, simple process that is tried and tested and it works. The hard work really happens when you actually buy the business and then, shit, what am I going to do now? You've got to then go in and look at where we can drive the sort of synergies and get a return. How are businesses typically valued? So I'm not just talking generally at Opulentian how we do it, but generally speaking, businesses are usually sold on a multiple of profits and balance sheet. Do you want to just sort of talk a little bit more around sort of how deals tend to be structured, how businesses typically tend to be valued?
Yeah, so if you do a masters on M&A, I haven't done the masters, but I understand what goes into it. There's a multiple of the EBITDA. So you look at, the typical industry average on the multiple of EBITDA within that quarter, and you essentially average what's happening with what this business has, and you come up with a typical multiple. You can also analyze the balance sheet. So on the balance sheet, you look at the net assets, and you can also look at the EBIT or the EBITDA, and have add a multiple to the EBITDA, and then include the net assets to it. At the end of the day, in my opinion, what it comes down to is, what does the seller want? What can you afford as a buyer? What can the business afford as a buyer in order to make it viable? And come up with a deal structure that meets both their financial needs, the financial motivations, but also their personal reasons. So a lot of the times when we buy into a business, you're buying into a business that has a certain reputation within a city. And when you buy the business from this owner, he's probably going to be meeting the management team at some point in the supermarket, right? So if as a buyer, you're a shitty buyer, and as a seller, you're not making it well, agreeing to a good deal structure, then it could bring in reputational risk and that kind of thing. So meeting both expectations around what the business can afford, what the motivations of the buyer are, and coming up with a number and a structure that meets their needs is what really comes down to, in my opinion.
I think Harvard Business School teach 126 different ways to value a company, and there are some nuances to it in that, if you're a tech company that isn't generating profits because you're probably reinvesting what you're making into developing your software or your IP or whatever, there is a bit of an anomaly with tech companies. But for pretty much most other sectors, certainly the ones that we're interested in, businesses sell for a multiple of their profits. That could be the most recent year, it could be an average of the last 3 years, 5 years, whatever, plus the balance sheet. But it ultimately does, as you say, boil down to what is a willing seller prepared to sell for, what's a willing buyer prepared to buy for, and whether or not those two things are aligned. And look, every day we will talk to a business owner that, we can't find that alignment. Sometimes we'll talk to someone that is, on the same page as us. So I think it's, very important to understand the financial components, but in my experience, it's actually more to do with the buyer, what they're going to do. Are they going to change the name? Are they going to fire the staff? Are they going to change the business model? As a business owner, if you've spent many years building up a reputation and a brand name, and people respect that, whether it be your staff, your customers, your supply chain, you as a business owner, even though you might sell up, take some money and off you go, I've found that probably 90% of the time the business owner is more interested in not necessarily selling for the highest price, but more to somebody that's actually going to build upon it, look after their staff, and not do anything fundamental. So it's not to say that we won't modernise or change processes and stuff, but there's I guess a certain way of being able to do that. And certainly our model is about treat your staff as you'd want to be treated, give them the opportunities, give them the tools, give them the resources, so that they can build upon what that business owner has created. So sometimes I find as well that most business owners, they reach a certain level and they don't actually want the stress of expanding or growing. So you're almost, as an employee, potentially can feel like there's a bit of a glass ceiling. I can't get promoted or take on a bigger project because as a business owner, you might be comfortable with your lot. You might earn enough money to have the lifestyle that you want. if you go and open a new branch or get into a new country to expand your business, that comes with risk, and not every business owner is up for that risk. Particularly if they're looking to go on a journey of trying to exit from their business. So, I guess they're the things and the opportunities that we look at is, not how we can, change the business fundamentally, but how do we expand it? How do we grow it? How do we give our people, new sort of opportunities?
Yeah, I think one of the key things that I learned from you was put the right people doing the right things, at the right time, and give them opportunity to expand and achieve their goals, right? If you give them the opportunity to do that within your goals, so within your larger goals, you'll create this compounded effect where everyone will be happy inside the business, you'll be happy, employees will be happy, and they'll really work very hard in order to treat their customers and your customers in the best way possible, and the customers will indirectly treat your business very well, and they'll pay you well, and that will snowball essentially over time. So, sure. 100%.
So when we buy a business, we always use an SPV. Do you want to just talk a little bit about what an SPV is and why we use it?
So thanks for tuning into the Buy, Build, Sell podcast. Please visit buybuildsell.net in order to access our free community on buying and selling and building businesses, so that you can access like-minded entrepreneurs, get access to free resources, and be able to access content that is not available online that will help you on the deal-making journey. We promise not to spam you, and we will be sending you the next episode on your email for free at your disclosure. Thanks a lot.
Use one.
Yeah, so
Sounds like a disease, but it's
so an SPV is essentially an acronym, right, for a special purpose vehicle. So when you buy into a business, you want to make sure that there's some kind of legal protection and legal framework between you as a person and the business itself. So the business could go wrong, or it could go well, but there could be some kind of internal issue, right? I don't know, like some kind of staff has insulted the other staff, so they're like going into an argument, and that comes in with, you know, some kind of court issue, whatever. So you want to protect your personal interest from the business interests, and you do that through an SPV. The only purpose of why an SPV is set up is just to protect you legally from that acquisition, and also to create some kind of, clarity, right, or a cleanliness between what the acquirer is doing and what the seller is doing, and that transaction that's happening in between both parties. I think that's what it comes down to now at the end of the day.
Yeah, sure. I mean, it's basically a limited liability company, so that could be set up in any jurisdiction. Usually we set up an SPV in the country in which we're doing the deal. So if it's a UK business, it'll be a UK SPV. If it's a US, it'll be a US SPV. And basically the liability to that company is limited to whatever the shareholder investment is. It protects assets, it's just a clean structure to use. So, okay.
And when you're going to buy a business, Paul, and you run through the diligence process, what do you tend to look into when you buy the...
Yeah, I mean, a lot of people think in mergers and acquisitions that actually due diligence is a process to chip the price, knock them down in price, to negotiate a better deal. Actually, from our point of view, it's not. We just want to satisfy ourselves that we're buying a pretty good business that we think we can do something with. So, certainly in somewhere like the UK, for example, there's a lot of data out there in the public domain. I can Google the business, I can see what the customer reviews are like, I can look up the financials on Companies House. So you can generally, before you get into a deal or even engage with a business owner, do your own sort of very high level due diligence to get a bit of a feel for, is this a business that I'm interested to buy? But once we've signed a term sheet and we start looking under the bonnet, if you like, there's three sides. There's the commercial side, so how do they do business, what's their business model, what's their revenue model, what's their competition like, and we sort of do a bit of a SWOT analysis. So what are the strengths of this business, what are its weaknesses, where are the opportunities, what threats does it face, so that we can build up a bit of a picture for what investment might be required, what opportunities are on the table, and that we're not getting into something that's too risky or going to cause us a problem. There's the legal side, so you're looking at contracts within the business, employment contracts, for example, contracts with suppliers, contracts with customers, and you're looking for sort of T's and C's, and how they're set up to do business, and the constitution of the company and all that sort of stuff.
What are T's and C's for the audience? Terms and conditions.
Yeah, terms and conditions, yeah. And then finally it's the financial due diligence, which is probably, from my point of view, the more important side of things, because generally we won't approach a deal, look at a deal, unless we've done some very high level, so if we look at a brand new sector, we'll have understood the market, we'll know what the opportunity is, the size, whether it's growing, all of those sorts of things. But the financials is where things can go wrong. Take a business that maybe is a product business and it's got stock. There can be a lot of things that can go wrong in terms of stock valuation and stuff like that. So we're looking into the financials, what's on the balance sheet, what are the liabilities, are we okay with all of those things? And we use all of that data to then build a very detailed financial model to make sure we know that it's affordable. If we're going to put new debt into the balance sheet to buy the business, then we want to make sure it's affordable, it's viable, we're not over leveraging ourselves.
Yep. Some of the things that we look at inside the financial projection is we look at the current market variables, so cost of living crisis, right? Will we need to increase the salaries by, say, 5% over the next couple of years so that the employees are happy? Yes. Will we need to adjust for the cost of energy? Probably yes. Cost of, the supply chain, things like that are things that we need to focus on when we do financial projections for the future. So something to definitely take into consideration. And then in terms of deal structures, there's a lot of potential deal structures that are out there and so on. We utilize the leverage buyout model ourselves, where there's an amount that comes up front on day one, there's an amount that comes on a deferred basis. We have some kind of securities on the deferred. We utilize debt as an instrument to make these deals happen. I think it's the cleanest way of getting a deal done and getting a deal over the line. What's been your experience with different deal structures when looking at buying a company?
Yes, I mean, I've been doing this for 13 years now, and I guess we've perfected the leverage buyout model. There's many different deal structures you can use. We've chosen leverage buyout because that works for us. I think it's if you've got a business that's got some sizable assets behind it that can be borrowed against, that's a way to give the business owner some capital event in terms of an initial consideration, and the balance can be paid over a period of time, whether it's an earn-out or whether it's just a straight deferred note. But what we're making sure is that when you look at all of that as a whole, that it's affordable. So it's a bit like when you buy a house. Most people borrow the money from the bank to buy the house, and their salary is enough to cover their cost of living expenses and, most importantly, their mortgage. And we're really only doing the same. We're looking at this business has got enough assets to support this debt, and this debt is affordable and can be repaid over a period of time, and it's not going to over leverage the business. So that for us is key. So I guess it's always a bit of you're between a bit of a rock and a hard place when you're talking to a business owner that wants a higher valuation or more money up front. If the balance sheet doesn't support it, if it's not affordable, then it's not going to work, regardless of what that business owner may think their business is worth. It's also got to be affordable and viable.
And when we talk about capital events, is small and medium-sized businesses are very illiquid, so they don't tend to have, you could have real estate, you could have plant and machinery, you could have a debtor book, you could have a lot of assets, but you don't really have access to capital. So what we're trying to do is we're trying to release that capital that is currently within the business, so that the business owner can get access to it, and then also obviously sell the business on and move on with the succession plan. And in terms of assets, Paul, what assets do we tend to focus on when we buy into a business?
Yeah, so I guess the easiest way to do a leverage buyout would be to put some sort of invoice finance facility in place. That's probably the easiest form of leverage. It's a fairly straightforward process. The lenders are pretty secure because you're basically borrowing against your future receivables. So not that it would be the intention, but in the event that this all went belly up and it didn't work out, the lender is protected because all it's doing is collecting in the money that's owed by the customers. Yeah. We're just getting an advance on that. So that's the easiest type. And if it's a contractual debt, so let's say you're in construction or engineering, there's prepayments, application of payments, that sort of stuff, typically you can borrow 50% of your debtor book. If it's non-contractual and it's just, you deliver a product and you get paid within 30 days, you could probably borrow up to 90%. So trade debtors is probably the first place we look. Real estate, you could leverage the real estate, you could carve it out, you could do a sale and lease back. Plant and machinery, if you're an engineering business, you've probably got lots of big CNC machines that cost hundreds of thousands. If as a business owner you've bought them out of cash, you're probably sat on a load of machines that are unencumbered, so you could borrow against those. We don't leverage absolutely everything out of a business, but we're looking at all of these things and looking at what sort of options are available to generate that initial consideration.
What's really interesting about buying businesses in the market that we're in, so like traditional baby boomer companies that have their real estate behind them, is for a lot of real estate investors that want to build a commercial real estate portfolio, there's obviously millions and millions of commercial real estate pieces that are hitting inside the balance sheets of small and medium-sized businesses. So if you wanted to build up a commercial real estate portfolio, you could potentially do that through buying small and medium-sized businesses as well, right? Which is something that we're looking into right now.
Yeah, absolutely. We like to buy businesses because they sell for a multiple. So if we buy for this multiple, build the profits and sell for either the same or a higher multiple, then we're making a return on what we've done. I personally find it easier to push the dial of a business to make it more profitable, to sell it and create more value from it. Real estate is a little bit different because bricks and mortar, it's worth what it is today, and maybe in 3 years if the market rises, it might be worth a little bit more. But so from our point of view, we're always more interested in what we can do to turn that down on the business, because we can really add value there, and real estate almost becomes secondary, but there is absolutely an opportunity.
When you buy into a business, obviously there's a legal process, right? And normally you can have a lawyer, you can do it yourself. if you've got a legal background, as a buyer, what should you focus on inside the share and purchase agreement? So like share and purchase agreement is, as it says in its name, right? It's the legal paper that allows you to buy the shares of a business. What tends to go into that paper, into that legal contract?
Yeah, so I've seen many sale and purchase agreements over the years, and I remember one of the first deals I did. We were sort of sat on a board table like this, and the amount of paper of documents to be signed was literally reams and reams of paper. But did I read every clause in it? No. But you pay, I guess, an advisor to advise you on all of that. I think for me, when you're selling a business or buying one, you need a contract to protect you. We need to know what we're paying, how we're paying for it, when we're going to pay. We need to know exactly what assets we're buying. So yeah, we're buying the business, but what does that business have? It's got its goodwill, but what other assets and stuff are we buying? The due diligence process is fairly robust. But it's not foolproof. So one of the things that's built into the SPA is a load of warranties. So rather than us go and investigate absolutely every single thing about this business, we might seek warranties from the business owner that will say, I warrant to you that the business has none of these issues. And as long as it doesn't, then we're protected, and we've relied upon that warranty. And so they tend to be the typical sort of things that are in an SPA. It doesn't surprise me every time we do a deal. There's normally a lawyer involved somewhere that they'll be, dotting every I and crossing every T, and sometimes they focus on things that really actually don't make too much of a difference. For me, the fundamental things are, purchase price, when it's paid, the warranties. So you tend to find that when negotiations tend to get a little bit fraught, they tend to be those contentious issues that, somebody's unhappy about, and then it's trying to be commercial with those negotiations to either take a view on it or compromise or not compromise.
Yeah. So let's say you've bought the business, right? You've signed the share and purchase agreement. You've got that legal process. It's behind you right now, and it's first day as the new owner, right? So you become a director inside company's house, or whatever government system you're in. You're now officially director. What do you do? Now you've got employees, now you've got revenue.
Yeah, so again, it's a process. So the first thing we want to do is that whenever there's a change of ownership, whether the business owners are involved or not, there is always a big risk to the goodwill. Customers can decide that they don't want to do business with this company anymore because there's a new owner. Staff might not like the new owners and they might want to leave. Supply chain might get jittery. There's been a change of ownership. What's going to change? So the first thing we do is have conversations with all of those key stakeholders. Staff first, so usually that's in the first or second day. Then it's the customers, then it's the supply chain. And usually within 1 to 2 weeks of taking over, most of those conversations have taken place to protect that goodwill. The message really is, just because there's been a change of ownership doesn't mean that anything's going to change. It's business as usual. It's still the same name above the door. It's still the same people serving the customer. It's still the same processes. And it's positioned in a way that we are here to invest and build upon, which most people tend to be quite receptive to. So the first 30 days are really sort of protecting that goodwill, getting to understand how the business works, talking to the key stakeholders, building up those relationships. And then it's really about having a process of doing a handover. So taking what that business owner has created, learning as much as you can about how they do business, who they do business with, the processes that they adopt, and all of those sorts of things. And you sort of gradually hand over duties to the team that are behind the new owners. So, at the beginning, the owner's probably working quite full on, but maybe after 6 or 9 months, they're probably popping into the office once a week just to see how things are going, but they're not really getting too involved in the sort of operational side of things. So it's as I say, just a process. It just can be a long process, because if you're a business owner that's owned a business for 30 years, you've got all this knowledge in your head of how things work, and maybe not everything's written down. And we've got to try and understand all of that and learn all of that and get into those relationships that they've got with staff, customers and suppliers, so that we can ultimately become custodians of their business, and everything's orderly and the transition is as smooth as possible.
Yeah, I think it's about being consultative at the end of the day, right? Like, you're buying into a business, it's got its own culture, its own people. People have their own lives, so you need to protect what they've currently got right now and try and build upon it, right? And you do that through being consultative and learning as much as possible from it. And in terms of the people, like what do you tend to look into when we buy into the business, right? Day one, we've got the management, we've got the staff that are working on the day to day. Are the 3, 4, 5 key stakeholders that you tend to look at? So like the guy that's in charge of the management accounts, the guy that's in charge of the operations, sales, the operational side of things. What is it that we try and look into when we buy into a business?
Yeah, so for me, people are the biggest asset in any business. Sometimes I've heard people say the customer is king, customer is the most important person in any business. I actually disagree. I believe it's the people that work for you, work in that business, because if you look after them, they'll look after your customers. So it doesn't matter whether you're a junior member of staff, whether you're the cleaner or whether you're the managing director. Everybody working in a business plays a role. Some people play different roles to others, but it's about trying to understand what tools, what resources, what development they need to become either better in their job or climb the career ladder if they're ambitious. It doesn't matter which way round you do it, but everybody's got to have a path and understand where they're heading and get behind the vision. So the first thing we do is basically do an employee engagement survey. So we look at asking the staff what they like, what they don't like, and then we try and take the things that they like, and obviously we want to do more of that. The things that they don't like, we'll look at whether there's anything that could be changed that could make that work. So for example, we found in one business that we bought that they had an outside work area. So this was sort of maintaining caravans and motorhomes, and one site had an indoor workshop, so it was nice and warm in the winter months. But in the other site, it was all done outside. So December it'd be pretty cold in the UK. So actually, having heaters and building something was quite important to them, and actually that had business benefits because it reduced sickness and illness and all of that sort of stuff. So whilst there was an investment there, sometimes those things that really bother people, actually you could do something about. Sometimes it can be really small things. Sometimes it can be something that maybe is more fundamental. But it's a bit like market research. If you want to understand your market better, what your customers want, then what you need to do is actually go and have a conversation with them and understand them. It's the same with staff. Find out what's working, what's not working, what we could do better. Open the floor to ideas, and it's really about then trying to work with people to improve that employee engagement.
Yeah. I mean, I think this is one of the key things that you've probably learned through coming from like a recruitment background, right? So you first started, you want to go into the story of how you started your first business together with your brother Ben?
Yeah, so I started a business in the recruitment space in an industry I didn't know, had no experience of, which was a bit of a silly idea, really. But hey,
why do you think it's a silly idea, or it's actually a clever idea?
Because I saw an opportunity. So I worked in the real estate business. I ran my own team. I was then promoted to run multiple teams, and the way I did that was by building the business with great people. I realised that if I wanted this business to be better, I need to hire better people. I need to keep hold of them. So one of the things I'd do would be phone up people in my competition, invite them for a coffee, and then I would basically try and persuade these amazing people to come and work for me for whatever the reason was, whether it be better career prospects, more money, whatever. And I sort of thought, well, maybe there's a niche here to create a business doing this for other real estate companies. So I set up a headhunting practice, and we went on a 7-year journey of building this business up, initially focusing on real estate, but we got into financial services and a few other things, and it became more of a sort of recruitment process outsourcing business by the time we were finished. But it was a very interesting journey, and we learned a lot along the way. But it was about taking that opportunity and doing something different than the market was doing, and then creating a business off the back of it.
Yep. Very interesting. I think that's one of the key things that if you focus in on bringing in talent inside the business, try and see what the competition currently has, and see whether you can maybe grab 1, 2, 3 key people from the business and bring them on board. Maybe you can provide key benefits, more travel time or less travel time. Maybe become a shareholder inside the business so they're aligned with the upside. It's not even just about like the salary, right? Sometimes it's about like the culture. Maybe they could have more of a leadership position inside the business. So there's a lot of things that you can do.
I think for me the biggest thing in any business is the people. Yeah. If you want to be a better business, then hire better people, keep hold of them. So if you take Richard Branson, for example, he's made some public statements before about it's okay to be the dumbest person in the room, and I actually agree with that. A lot of people sometimes when they're in leadership roles can actually feel threatened if there's somebody underneath them that actually is maybe better or more experienced than them, then they can sometimes feel threatened. For me as a business owner and a leader, I want to encourage those people. I want them to step up. You know, do you think that Richard Branson flies the spaceships that he's building and sending off to space himself? No, he doesn't. He hires probably the best astronauts he can possibly find from NASA to go and fly these spaceships into space. And it's the same in any business. You need to hire great people, you need to keep hold of them, and you need to give them the tools and the resources and the space to develop.
Yep. There's this guy who built up Blackstone. I can't remember his name, but he mentioned that, you know, he probably wouldn't be able to make it inside his own company right now based on the recruitment process that they've got. And one of the key things that he focuses on is create opportunity vehicles so that 10s and 9s in the, you know, business world, on the employee world, want to work for you as opposed to for other people, so that if you can create a really big opportunity for these people, they'll take advantage of it and you'll go along with the ride, right? So that's one of the key things that I've learned. Think big, right? And bring in big opportunities for people underneath you. Any final words on leadership on your end?
Yeah, I think there's lots of material out there you can read on leadership and some really complicated stuff, but I think it's really simple. I call it the 3 C's. Give your people the clarity of what's expected of them, whether that's a target, a goal or objective. Give them the competence, so this is the training, the coaching, the feedback to improve their skill set, improve their knowledge, and then there's the consequence, and consequences can be good or bad. If you hit your objectives or exceed them, then this is the result. It could be a bonus, it could be a financial reward, it could just be a pat on the back and praise or whatever, and also the consequence can be bad if they don't meet their objectives. So what happens if they don't? You know, are they retrained? Are they dismissed? Or, you know, sometimes you have to have tough conversations with people and leadership, but it's really about, you know, really simple. Build the best team you can, give them the clarity, give them the competence, give them the consequence, give them the rewards, give them the tools and the resources to do their job and do it well, and empower them to become bigger and better.
Yep. So thanks a lot, guys, for listening to the podcast. I think hopefully you gained some valuable lessons and wisdom out of, you know, our experience at least.
We'll see you next time.
Yeah, see you next time.
Thank you for tuning into our podcast today. Have you tried our free survey to assess your skills as a deal maker? Visit www.buybuildsell.net/survey to take our free survey and assess your skills as a deal maker.